Hello, everybody. It's great to be here one more time today. My name is Gary Fowler. I'm the CEO, president, founder of GSD Get Shit Done Venture Studios, a premier AI and quantum venture studio located in the heart of Silicon Valley. I'm a 17-time serial entrepreneur with several unicorns under the belt. I was on the original management team of Click Software, which was sold to Salesforce for 1.35 billion, and also Eva.ai, an AI HR tech company I co-founded with Dr. David Jang. We believe at GSD that intellectual capacity is evenly spread, but opportunities are not. And with that, I'd like to introduce our incredible guest, Valmik Iyer. We're going to be talking about family offices and his journey managing money for families and family offices across multiple asset class, and what are some of the biggest mistakes they make, and why is it so important today. So with that, I'd like to bring Valmik on board. Hi, Valmik.
Hello, Gary. How are you?
Good. So how did you get involved in working with family offices?
So, Gary, essentially, it was a very dynamic journey, I would say. Nothing was planned as such, but once I kind of entered the wealth management industry back here in India, things just kind of evolved. And within the wealth management industry, the industry is structured in a very, in a way that, larger wealth outfits tend to manage money for more sophisticated and more niche clients who are normally either ultra high net worth individuals or family offices. So I luckily got a break into one of the larger wealth outfits in the country. And once I started working there, and once I kind of got up the ladder in that particular organization, I started working with a lot of these top tier family offices.
And how is it working with those family offices? Do you meet the family members? Do they talk to you about what kind of things you're there that you're investing in, and how closely do you work with them?
So it really depends, in all honesty. There are some families that are very, very interactive, and they get into every single nitty gritty of where the money is getting invested, what their requirements are, if they foresee any expenses for the business, for their own business, or for their own lifestyle, or anything of that sort. And then there's the complete opposite end of the spectrum where you will possibly never interact with the family. Everything is kind of taken care by their one down or two down, who they've kind of appointed for as their CIO or CFO, or something for their family office. You may interact with the main promoter, or the founder of the particular business, maybe once or twice in a year, but everything else is routed via the CIO or the CFO. So it really is very, very diverse, I would say, and it's very, very differentiated. It really depends family to family, and business to business.
It's interesting, and so what kind of money do you manage when you're doing that in dollars? What's a typical family office? How much money is it? Is it a couple million, or a couple hundred million, or a couple billion? What is it like?
So So anything over and above around, I would say around. So within the family office landscape, there are for an independent family to set up their own family office, which is solely looking after only their finances. A number of about 60 million or 70 million would be, I think, the benchmark. If a family breaches that benchmark of 60 or 70 million dollars in financial assets, that's when they actively look at setting up their own family office. By what I mean by that is actually appointing multiple employees within their organization who are solely looking after their finances and their portfolio. But any portfolio size below this threshold is normally managed by larger wealth management firms and larger multifamily offices. These multifamily offices and wealth management firms essentially cater to the needs of the family and kind of suggest and advise on how to efficiently go about managing their portfolios and their wealth according to the aspirations of the family. So,
And so, you've managed money for families and family offices across multiple asset classes. So what do you think are the biggest mistakes that the first time investors make? What are the mistakes? You've seen this stuff. What are they?
So one glaring mistake, I won't say mistake, it's something that people are actually now realizing, and that thought process is now evolving, is that probably, so like going back to 2018, in India there were just about 30 or 35 single family offices that were operating. Cut to now, year-end data of 2024, we have more than 300 family offices in India, single family offices. Now, what has actually changed over this entire time frame is that first generation entrepreneurs, they never really managed their wealth in a structured manner or a professional manner. It was very, very unstructured and very unprofessional. There was no goal aligned to this management of of their portfolio, of their wealth. Now over time, what is also kind of happening, and the realization is also kind of creeped into a lot of families, is that they need to kind of have a way to structure their wealth, to manage it in a very, very optimal manner. Everything used to be aligned to preservation of wealth. That, if they have 60 million US, they should always ensure that the portfolio doesn't fall below 60 million US, even if it may not be growing. Now the realization has kind of creeped in that, even if we have 60 million US as our financial portfolio, we need to ensure to kind of grow this, and we need to grow this above the inflation rate. And inflation in India is not the headline number that you kind of see that, okay, the RBI or the CPI report is 2% or 3% or 4%. Segmental inflation is very, very real here, because you have families who are probably flying business class or buying the latest Apple gadget or the latest Apple iPhone. That those gadgets and those services aren't growing at a stable rate of 2 or 3 or 4%. Those services and those assets are essentially, or expenses rather, are growing at 10, 12, 13%. So one families of this stature essentially need to also ensure that at least compounding their money at a double digit rate, to kind of ensure that purchasing power is kind of preserved with their financial portfolio.
And
So this
so,
realization is actually kind of gradually coming into a lot of families, and once they're kind of understanding this, this was probably a mistake earlier, which is something that they're kind of rectifying now going forward.
you often emphasize the power of compounding. For young professionals listening, what's your best advice on when and how to start investing? What do they need to do exactly?
The best time to start investing, Gary, would ideally have been yesterday. If you've not started investing, then you should start investing as soon as possible. The younger you are, the better it is, because you have age on your side. The easiest way is to kind of um, ensure that you have at least some money deducted on a monthly basis. And even if like back when you've just started your career, you may not have a lot of money to invest, because a lot of money is actually going in living expenses. The easiest way is to, maybe even if you're setting aside 1 or 2 or 5% of your income, it's important to inculcate that habit, so that as your career also kind of grows over time, as your income also grows over time, you're able to really uplift that allocation. Instead of saving 2 or 3 or 5%, you're able to actually save and invest 10, 15, 20%, which is when that meaningful number actually kind of comes about. So it's important to just start as early as possible, and the easiest way is to do it via either a passive offering like an ETF or a mutual fund, or just start buying large cap companies, because the more, you may be wrong initially, but the once you actually start tracking the markets, and once you start tracking the companies that you're investing in, that's how you'll actually go ahead and learn.
Many investors chase these undervalued stocks just because they look, cheap. How do you teach people the difference between price and value?
It's in all honesty, it's not a very easy job. You have to kind of really get into the nitty gritties of a business. You need to kind of, more than kind of just seeing price and value, the price of a stock always moves in line in the longer run with its earnings growth. So you need to kind of see if the business that you're investing into, you need to kind of look at it as a business owner. Are you allocating capital to a company that is actually growing its profits, growing its sales? If you aren't doing that, then it's a question mark. Why are you allocating money into that particular company? So at the end of the day, you need to kind of see where your money is going. If that business is actually able to grow at a 8% or 9% or 10% per annum kind of scale, or a higher scale, the higher the better. If you're able to find such a business, then you need to kind of look at what valuation you're getting it at. It shouldn't be absurd that you're paying a very, very high multiple For example, if you're getting a consumer company, maybe a gadget manufacturer at a much cheaper valuation as compared to one that is, if both companies are growing at the same rate and you're getting one that is much cheaper than the other one, then you kind of go and buy the first one. So you need to kind of, once you're able to find a business or an industry which is growing at a healthy double digit rate, that's when you kind of look at which business to kind of enter into.
So what role do you see alternative investments playing with wealth creation? And here's the other thing: what about AI in longevity? I deal with a lot of family offices too, and many of the family offices are incredibly interested in how they can live longer, and also with AI and quantum computers. But what do you see? How interested are they in those things? Like an open AI in the world. How interested are they in finding those kind of investments that are going to be decacorns?
AI, I think, it's definitely a game changer. More than for investing into, of course, there are a lot of structural themes that have come about, but like it's just made life so much more simpler. Basic, the most bare minimum thing essentially when you're even analyzing a particular company or an investment option, rather than going through a 50-page or a 100-page investment memo, what a lot of people are now doing is they're simply uploading that investment memo on an AI tool, and they're telling AI to just kind of say what are the reasons I
Right.
should
Give
invest
me a
and what
one
are the
pager so I can figure this out, right?
Exactly, exactly. And that's just making life so much more simpler for these people. And that's something that is definitely here to stay. So I think understanding and using AI to make your life simpler and to make your analysis sharper, that is something that one needs to kind of live with and understand. Because if you're not doing that, then you're at a disadvantage from day one. So this
Time.
is
Go ahead.
So I was just saying that this is something that we're seeing as more of a structural trend with a lot of family offices and with a lot of investors on the whole.
Time in the market versus time in the market, Valmik. You've spoken about this before. Can you share a story, for example, that really drive this point home?
Timing the market versus time in the market. Time in the market will always beat timing the market. A very simple example. We all remember how 2020 was essentially, and this was not just restricted to the Indian markets. This was kind of a global phenomena with across asset classes and across global markets, where we kind of saw a huge correction in February and March of 2020. Um, we were working with a client essentially back then who had just gotten a larger corpus to kind of start investing into the markets, and this was somewhere around mid of 2019. So the way we had structured his investments was that about 50% of his portfolio, 55% of his portfolio, was going into equity and equity oriented assets. That deployment actually took place from June to December of 2019. Now, at December of 2019, no one really knew that COVID is going to hit and kind of shake the entire ecosystem and the entire world. So everyone his money had kind of completely been deployed, and he wasn't sitting on a lot of cash to kind of take advantage of any opportunities in case any do arise. What went on to happen is that if $50 was invested from June 2019 to June 2019 to December 2019, by the time March 2020 ended, that $50 was just worth about $32 or $33, sitting on about 35-40% notional losses. And of course, when you see your money evaporate by 35-40% in a matter of 3 months, it is reason to panic. And no one can really, with a sane mind, stay sane at that time. But of course, that's our job as wealth managers, as investment advisors. We kind of try to point data out and try to show at least our clients, what data points we're seeing and why you should be worried or why you shouldn't be worried, and take a data oriented approach and a data oriented action on it, essentially. What went on to happen after that, because a lot of this money was invested in Indian markets, the rally we saw from there on was phenomenal. And that 50 rupees that was actually invested from June 2019 to December of 2019, by October of 21, that is, around 18, 20 months after the massive correction that we saw in COVID, that $50 was actually worth more than $150. So it went more than 3x, even though that we were sitting at a point in time where, that money was down about 40%. That is one thing that we saw, and that's where the entire thesis also comes, that you need to at least stay invested for one entire market cycle. We saw the entire opposite happen with another client, where when the markets were correcting on a daily basis, he was like, Valmik, the markets are going to fall further. Please take all my money out today. I'm going to reinvest everything in a month's time when the markets are at their all time lows. No matter how much we told this gentleman, he was like, no, no, I'm super convinced. I've spoken to X person, Y person, Z person. This is my analysis. Pull out all my money. I'm going to reinvest it back in a month's time when markets are at their all time lows. What actually went on to happen, Gary, was when we actually pulled his money out, because he forced us to do it. Because at the end of the day, the client always has the final say. We're just mere advisors to what
Yeah,
he knows
yeah.
what he shouldn't do. What actually went on to happen, Gary, is when we pulled out his money, actually that turned out to be the all-time low of the market. And he was never able to actually find that market low to reinvest his money.
Well, you can never find the bottom, right? You can never
Exactly.
do it, and the problem is if you think you can, that's why you lose money. And I've been there myself, going down through and trying to probe it. But the other thing is, if you believe in the stock, right, and you stay in the market, you can't like get nervous and things. You got to just let it roll. You can't be screwing around with it, and that's where you have a problem, right?
Absolutely. And if you're right one time, you'll kind of keep wanting to do it again and again and again,
Yeah,
and
well,
that's
it's like winning the lottery. You get a lottery ticket, and you win $1,000. All of a sudden,
yeah,
you think you're a genius, and you got the Midas touch, and that's when the bad stuff starts happening.
absolutely, absolutely.
Outside of finance, you're a fitness enthusiast and golfer. So, do you see parallels between the sports fitness discipline and long-term investing discipline?
Absolutely. All of these things have a couple of things in common, or these three aspects that you mentioned. The first thing is discipline, essentially with fitness and with investing, and even with any sport for that matter. You need to be very, very disciplined in your approach. Essentially, with fitness, you need to kind of at least be doing some sort of movement every 3 or 4 days a week. You need to kind of get that movement in, whether it's hitting the gym, whether it's going for a short run, a 3 or 4 kilometer run, or it's doing some other activity which kind of at least helps burn some calories. That discipline needs to be maintained, and if you kind of falter over there, over time you'll kind of see your fitness levels also kind of come down. Same thing with sports, and same thing with investments and investing, and especially managing money. You need to be very, very disciplined in your approach, to how you're kind of going about managing your money, and you need to stick to certain processes that you've kind of developed over time. So that's very important. The second thing, and an equally important thing, is integrity. um, Integrity is extremely important with any sport. You need to be a fair player. You need to have some sort of compassion for your opponents, for the sport in general, and that mutual respect. Same thing applies when you're managing money, especially managing money for others as a living. Integrity is probably the most important aspect there is, and especially when you're managing money for someone else, you need to be
Well,
as fair
because
as
they
possible
trust you, right?
and
They
as
trust you to
transparent.
measure their. They trust you to take care of their money, and they want to make sure it's a win-win. If you win, they win, you win, etc. That's a good thing, right?
Exactly, exactly. So that trust gets built over time, and because of which you need to always maintain a high level of transparency, especially in this industry and in this profession. So these are two things that over time I've come to realize, that given how I've grown up, I've been lucky to kind of have inculcated both of these habits, which are directly helping me in my profession now.
What trends in customer expectations are you noticing? Are families looking beyond returns toward purpose-driven or sustainable impact kind of investing, or what are you seeing for the family? Do they care now, or they just keep going forward making money?
So it's a very good question, Gary, because essentially what we're seeing now is that with a lot of second generation entrepreneurs actually coming in, taking the helm of a family office, or at least calling the shots over there, a lot of them are much more ESG oriented. They really care as to what is happening to the environment, what governance standards there are, how sustainable any particular business is or isn't, especially on the ESG front. And they have a lot of covenants themselves that they do not want to invest in any sin industry, any gambling industry, or any other kind of sin industry. You kind of understand what I'm saying. These kind of covenants are actually much more stricter with these second generation entrepreneurs. It's not simply that if they're finding an opportunity to make a quick buck, regardless of who it's harming or who it may be doing injustice to, that they'll go ahead and take it. They're really much more compassionate with these kind of understandings and these kind of things. A second thing, a larger thing, is also a little more inclination towards philanthropy. Um, a lot of family offices that we work with, they're actually more inclined to at least have some purpose, apart from of course, progressing their own family net worth and their own business, and to kind of start giving back to the society. That's
Do they
something that
really care that much, so Valmik? Do they really want to give back, or they're just doing it for optics to show people? What do you think?
um no, I think when you have a philanthropic plan in place where you're kind of donating a percent, or half a percent of your overall net worth every year. When that kind of plan comes in place, which a lot of families are now kind of putting in place for through a lot of their family offices, to support a cause or two three causes that they're very very passionate about, um, that's a significant amount of money that is actually going to that cause. So it cannot be solely for show, because that's a lot of money and a lot of time that they're actually putting in. So there is that compassion element that does come in, and a lot of these families actually don't even publicize these things. So uh,
Well, I mean, they're very clandestine. Sometimes you don't even know which family is what office because all it says on a LinkedIn profile is family office. It doesn't get into any of the details, right?
exactly,
They do it
exactly.
because they don't want people to know that they may be an investor in a competitive company that's competing with the company they founded. They don't want to go down through and have somebody scrutinizing what other, you know, purchases are and things, right? They're
Completely agree. Yeah,
it's
yeah.
interesting. And so, how clandestine are the families, Falmik? Are they open to let people know that they're investing, or do they keep it low profile?
Actually, a lot of them keep it very, very low profile. There are very few that have actually come up the ranks, probably because of a lot of investments that they've made that have done very, very well for them. That's how they've kind of come into the limelight. But a lot of family offices that are now getting set up are very, very low key and low profile. They don't even want to know who's working with them, where they're investing, and what they're kind of doing internally, which makes a lot of sense because over time, like I just said, the number has gone almost 6x, from 45 to more than 300 in the past 5 6 years. This is only set to grow with a lot of liquidity events that are coming into the markets. With Indian markets doing so well over the past few years, a lot of promoters and promoter families are now looking to offload a small portion of that business holding that they have to set up their family office. And again, with Indian markets doing so well, the second generation especially has now come to a realization that there's more than one way to actually make a good amount of money in the world. It's not just by running your own business, but if you're actually wisely investing your money.
Yeah, no, I agree. A lot of my friends, invested in things like Bitcoin when it was three or $4,000, and now it's 120 or whatever. They made a lot of money. They put a few million in, and now it's crazy, right? And but
Absolutely.
you gotta like, you know, jump into some of these things, and for each one you get that's a good one, there are 10 bad ones, right? That you get into. So you
Absolutely.
gotta make sure you're picking the right winners. Um, what's the best piece of financial advice you've given to friends or family that still makes you smile today? What's something you said, invest in this or do this, that you've done to your family that makes them happy today?
I think the biggest thing, that a lot of that I have done for my family, and like at least help a lot of my friends with, is to get them to start investing in equities. This is one major asset class that is going to do phenomenally well for the next decade. And what you can anticipate, at least with equity, is that if corporate profits, the nominal GDP growth of India is somewhere around 10 or 11%. Real GDP growth is somewhere around 6-7%. There's a 4-5% inflation to it. Comes to around 11 or 12, 10 or 11, 10 or 12% essentially.
Great.
And what you can anticipate from the equity markets is to kind of continue to grow at that rate, 12 to 13% rate over the next 10 years. People who are not investing in equity and who are just simply leaving their money in debt are not going to beat inflation, and especially not going to beat segmental inflation like we talked about. So the biggest thing that I've kind of helped my friends with and my family with is to start getting them to invest in equity,
Yeah.
and to make that as a process and make that as a habit. Because once you start your SIP, so SIP is basically a systematic investment plan. That's a term used in India, which
Yeah.
basically means every month, no matter what, an X amount of money will get debited from your bank account and go towards equity investments.
Oh,
So
that's
one,
great. That's really good.
yeah.
Fantastic. So we're coming up to the top of the show. I'd love to stay on, but we're coming up. If you weren't in wealth management, what career path do you think you would have chosen?
Very, very difficult to answer that in all honesty. I think so. The only thing I know for the past 7-8 years, I've been breathing and living this, but probably would really try to do something in sports if it wasn't for this, either sports management or become a sports person myself.
No, it's we appreciate you taking time out of schedule, and if you want to stay on for a few minutes after the call today, after the show, we feel happy to do that. Okay. Anyhow, I want to thank you for joining us. We really appreciate you taking time out of your busy schedule, and I'd like to thank all my audience for joining one more time. GSD presents Top Global Startups.
Thank you so much, Gary. It
Fowler,
was
and I'm your
really
host.
great, great being on the show.
Thanks, Valmik. Thank you very much. So stay happy, stay safe, and stay healthy. And we'll be back again soon with another exciting edition of GST Presents Top Global Startups. Thank you.